Hello, fellow traders. How are you doing today? I hope you are doing great. How has been your trade this new trading week? I hope you are killing the market. All right, today I want to show you about. I want to talk to you about inducement. All right, I want to talk to you about inducement. This is very, very important. It is a concept that you need to know. Inducement is a concept you need to know in order to increase your win rate and to avoid unnecessary losses in the market. Inducement is a concept you need to know, especially for demand and supply traders, smart money concept traders, ICT traders. Okay, you need to know inducement, or else you cannot to have unnecessary losses. So what is actually inducement? Actually, inducement is actually manipulation. Okay, is in short form. Inducement is manipulation. Price is actually price manipulation. Okay, and this manipulation is actually done, is a price manipulation is done by hedge funds and big banks, and also large institutional traders. Okay, this that is actually a manipulation. This manipulation, price inducement, is actually price manipulation by hedge funds, big banks, and institutional traders. Actually, what do? They manipulate price by initiating a short-term price movement in order to attract retail traders to either buy or to sell a currency pair. And when they now buy or sell a currency pair based on the moves initiated moves by these big banks, hedge funds, and institutional traders. When you now enter a trade based on the moves initiated by these hedge funds, you discover that when you now do that, your stop loss will get hit, because they will now drag the price in an opposite direction. Okay, they will now drag the price in an opposite direction. So it's just like a deception. So your stop loss will get hit. So they initiate these moves in order to accumulate orders. They initiate these moves in order to actually accumulate large orders. And when they see that these large orders have been accumulated, they now move the market, because they're actually trading with a large sum of money. Okay, so they move the market in an opposite direction, and now your stop losses are now hit, and this results in massive losses for retail traders. Actually, something I want you to understand something. If you're a smart money trader, if you are institutional trader, you are an ICT trader, you are all retail traders. Just that you trade you want to trade like the smart money, like the institutional traders. So you need to understand that these big banks, they know what you are knowing. They know what you know. They see what you are looking at. This same chart that you have, they are looking at. They see where the others are. They know what you are doing, and so if they want to take out your stop losses, they know what to do. So that is why you need to understand what this concept is, of this concept of manipulation, and this concept of manipulation called inducement. Okay, I'll show you just in a while in the chart how this works. All right, so you need to understand that you need to base your market decision, your trade decisions, on a larger and longer time frame. Okay, and overall of your market decisions, your trade decisions should be based on long-term trends instead of short-term trends. You should base your decisions on long term trends. Okay, trend instead of short-term trends. Okay, so you should base your decisions on long-term trends instead of the short-term trends, in order to avoid having your stop losses to be hit at all times. And also, you need to use proper position sizing. Ensure you use your stop losses. You use proper position sizing. position sizing, okay, risking like 1 to 2% of your capital, and also ensure that you use your what? You always use stop loss while trading. Okay, stop loss while trading to avoid these kind of manipulations, to avoid to just like as a form of protection against these manipulations from these high institutions, these institutions and these hedge funds and big banks. All right, so let me show you what this manipulation looks like, this inducement. I want to start first with the bearish inducement. Okay, you have price move like this. You have price making lower lows and lower highs like this, lower lows and lower highs like this. Okay, so this is a break of structure, lower bearish market structure, break of structure, break of structure. Okay, this is your break of structure, another one, and break of structure. All right, so ordinarily the expectation is that when price comes here, when price comes to this point, this zone, this supply zone that actually caused this break of structure, the market is supposed to react and sell from there. But you need to be careful because this is a potential inducement. This is a potential form of the potential point of inducement. What do I mean? They call this these large institutions, higher financial institutions and banks, big banks and hedge funds. They know that you would want to take your trade from here. Okay, they know that your aim would be to take a trade, a sell trade from this zone that caused this break of structure. Okay, you want to take your sell trade from there, but be careful. You need to be what? You need to be very, very careful, because what they do most times is that they know that they use this point as an inducement. So what they do, you would place your limit order here, or sometimes you see a small sell right here, and you think that this is going to sell, the market is going to react from here, not knowing as an inducement. So then sometimes they will step up higher, taking out your stop losses and sell from this zone right here. Okay, or they might also go up higher, taking out all the stop losses right here and sell from this higher zone. But most likely, most times, the first one is mostly going to be an inducement. I don't know if you understand what I'm saying. So this is, you need to avoid this last lower high. Okay, might be an inducement. So you need to very, very careful. I'm going to show you how I'm going to avoid this later on. So here, when they want to sell from here, you're going to have something like a break of like a change of character, and now like a change of character right here. You have a change of character right here, and now you have your return to order block, and the market will now sell from here. So this, you have to be aware that this is an inducement. So let me show you the bullish scenario. For the bullish scenario, you have the market creating higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Okay, so and this is a break of structure to the upside, break of structure to the upside, break of structure to the upside. So this is actually a bullish order flow. Okay, this is a bullish order flow because the market is creating higher highs and higher lows. All right, so now most likely you would think you would want to take retail traders want to take a trade right from here, from this zone, that broke this structure. All right, so but most times this could be an inducement. Okay, this could be an inducement because when you come here to take this trade, you could have a little bit of a buy, and now the market comes down, taking out your stop losses. And now also, so they might want to take the trade right from here, from this zone, instead of this. This is most likely going to be an inducement. So they come right here, respect, because they will now have a change of character right here, and return to order block, and the market buys. And sometimes, but most times this would work, but sometimes they might still come down right here. Okay, they might still come down to this zone. Okay, sometimes, but most times this one will work. So they might come down to this zone and have to take out all stop losses right here. You now have the desired change of character and return to order block, and now you have the desired buy trade that you are actually looking for. This is actually a bullish scenario of an inducement, a bullish scenario of an inducement. Okay, an inducement to enter a trade which is going to result to a loss. All right, an inducement by the smart money, by the big banks, the hedge funds, and the institutional traders, okay, for you to enter a trade that is ultimately going to result to a loss. So that is why you need to be very, very careful. So let us look at the short examples of what I've been talking about. Okay, I've just marked a little some of them. Like for example, now you can see in this case the market was breaking structure to the lower side, and see this is a break of structure to the lower side, break of structure to the lower side. So now you do this is you would want to take your trade from this point, this position, this supply zone that broke structure, but now you discover that this is most likely going to be an inducement, because price actually came and did a bit of a sell, but actually ultimately came right up to the next zone. You have your break of structure, change of character, and the market now sold. Okay, so this was an inducement. Okay, this was an inducement that resulted to a loss, a hit of a stop loss. So let us see other example. Let us look for this is another example. Okay, this is another example. The market here was creating higher highs and higher lows to the upside, and now there was now a break of structure to the lower side, a break of structure to the lower side, and now this was actually the supply zone that caused this break of structure. And now you most people want to take their trade from here, not knowing that this is actually an inducement. So what happened in this case, you could actually see that the market, but it did not respect this inducement zone, came right up. There was a break of structure, change of character, return to order block, and the market sold. So this was actually a loss. This trade from here was actually a loss for retail traders that have no idea of inducement. All right, so this is another example. So let's see another one. Okay, you can see another one. This is a beautiful example too. You can see the market was creating lower lows and lower highs, and you can see that this is actually a very good point, very good point to take a trade, very good point to take a trade that should have resulted to a win. Okay, this was a very nice position to take this trade, but you can see right now that this trade resulted into a loss, because it was actually an inducement. Okay, it was an inducement to sell. Okay, but the market makers went right up and triggered the stop losses right here, and took the trade from here. Okay, so this is another example of an inducement. Okay, so now let us see. This is a bullish example. Now we have seen the bearish example. Now let us see the bullish example. So for the bullish example, you can see here that this zone, this break in market structure, the break in market structure here was triggered by this demand zone. So you would want to take your sell trade from here. Okay, not knowing that this is actually an inducement. So the market makers took out your stop loss in this case and came right here, and you have your desired buy. Okay, so this is a bullish example of inducement. Okay, do we have another example? Let us see. Do we have another example? Okay, we have another bullish example right here. Okay, so this is a beautiful one. It's a beautiful one. Okay, the market was creating higher highs and higher lows. Okay, showing that is a clear uptrend. It was a clear uptrend. So, and we would want to take our buy. Want to actually take our buy from this. You can see that this last structure, let's assume that the market was like this. Okay, let's assume that this was actually the market, okay, from this point. Okay, so now this structure was broken. This last structure was broken was actually broken from, triggered by this last demand zone. So this is actually a good, this was supposed to be a very good point to take your buy trade from. Okay, but then it turned out to be an inducement, right there. So what happened? The market makers came right here, took out your stop loss, and went down further, and there was a buy from this zone, and this zone was the inducement. All right, this was the inducement. So I hope this concept is clear. Okay, I hope this concept is clear. So I want to show you how do you avoid how to avoid in this inducement. How to avoid this inducement? How do you avoid the inducement? So I want to show you three things that you can need to be doing. No matter how you try, once in a while you might still fall for it. I still have losing trades from time to time, as you are aware. There is no trader that does not encounter losing trade, no matter how professional you are. But then we can only reduce these losses, okay, by intensive market review and analysis. Okay, but then we cannot totally 100% eliminate losses. So, but how can you avoid being a victim of inducement? Okay, number one is that you need to always shake the higher time frame order flow. Always shake the higher time frame order flow so that you can know order flow or structure. Always shake the higher time frame order flow or structure so that you can be able to know the direction of the market. Because if you base your trading decisions on lower time frame and lower time frame and short-term trends, most times you could be on the right side of the market. So even if you're going to enter in the lower time frame, ensure that you are entering in line with the higher time frame market structure order flow. All right, market structure order flow or trend. The trend is always your friend. Okay, always better to enter based on the higher time frame trend. Okay, now the second thing you need to know is number two, you should take trades from extreme zone. Okay, always better to take trades from extreme zone. Okay, what do I mean by extreme zone? This is an extreme zone. This is an extreme zone. This is an extreme zone. Okay, avoid this type of zone. Avoid this type. Okay, this is not this. Avoid this type of zone here. Avoid this type of zone. Okay, so take trades from extreme zone. Trades taken from extreme supply and extreme demand zones work better. They have a higher chance of success. Extreme supply and extreme demand zones, extreme demand zones, extreme supply zones have higher chance of success. Extreme zones have higher probability. Okay, extreme zones have higher probability, and when we are talking about zone, we mean supply and demand zones. Okay, or other blocks, or bearish order block and bullish order block. So better to take trades from those extreme points that they have higher chance of success, because there are no inducement on the line, in the line of your trades. Okay, so this is very, very key. This is very, very key that you understand it. So the third thing you need to do is to number three. Third thing you need to do if you want to avoid inducement, being an inducement, a victim of inducement, is to you always use entry confirmations. Okay, avoid limit order entries. Avoid limit order. Okay, so I've made a video on how to get entry confirmations. All right, how to reduce, how to get modify your entry, how to get refine your entries. I've made a video on that. I might link it up in the description box of this video. Okay, so better to use entry confirmations. You would have higher win rates. Okay, instead of using limit orders to get into a trade. So these three things, if you do these three things, I guarantee that you would have a higher chance of success, even though there's no chance that you're gonna win all your trades. It's not possible. Nobody wins. There's no 100% win rate strategy. But then what we can do is to have measures in place to improve our win rate. All right, our win rates, and have a good risk to reward ratio. So that is actually what matters actually in forex trading. So I will be making more useful contents for you along the line. I'll be making more useful contents. I post video every week. So do not miss any of my videos. These are educational content that will help you to make more money from the forex market and also in business generally. So if you want me to mentor you personally on forex trading, one-on-one mentorship, my contact details is in my free Telegram channel. I have a free Telegram channel, and the link to that channel is in the description box of this video, and also in the profile section of this YouTube channel. And in that free Telegram channel, I give free chart analysis, and which you can actually trade in at your own discretion. All right, you can trade it at your own discretion. So you also want me to mentor you. I've told you, you can find my link, my contact details in the description box of this video. In the Telegram channel, you get my contact details. So till I come your way next time, I want you to please kindly subscribe to this channel. If you're yet to do so, subscribe to our channel and turn on the notification bell so that you can be alerted when I post new video, which is every week. So please do that. Share our video with your friends so that they can benefit more from our content. So till I come your way next time, do have a blissful and a wonderful day ahead. Thank you very much. Bye.